Hello and welcome back to Accounting 201. I'm your host, Dr. B. Today we're going to cover Chapter 3, the adjusting process, and we'll also cover Chapter 4. This is a two-part video series. A few housekeeping notes that I'd like to discuss. Most of you have been wonderful when it comes to getting your work for Chapter 1 and Chapter 2 in on time. So thank you for doing that. Timeliness, as you know, is super important, especially in an 8-week course. We know that there's a lot going on, okay? Every week we cover 2 chapters. The first week we covered chapters 1 and 2. In week 1 you had your introductions, chapter 1 quiz, chapter 2 homework. Most of you have completed chapter 1 quiz, chapter 2 homework on time. For those of you that didn't, those students are currently in jeopardy of failing the course. Why do I say that? Anytime that you're not active in one of these weeks, especially that first week, I have to report your missing attendance to the university. What does that do? It puts you in jeopardy of losing any type of financial aid that you have and potentially being withdrawn administratively from the course and from the university. So in order to prevent that from happening, please make sure that you're active in all your courses. Very, very important. So week 1, you submitted your chapter 1 quiz and your chapter 2 homework. All of that has been graded and posted to the gradebook. So thank you. As a reminder, after the due date, if you want to go back and try to do better on your chapter 1 quiz or your chapter 2 homework, you can do that. All you need to do is you go back into week 1 and open up that quiz and that homework and do it again. The quizzes, as a reminder, those can be taken up to 2 times, and the highest grade is accepted, right? So that's cool. So if you want to try to earn a higher grade on chapter 1 quiz, go ahead and take that quiz again. You're able to take it up to 2 times. When it comes to the homework assignments, even better news here. Homework assignments can be taken unlimited times, and the highest grade is accepted. That's cool too, right? And so if you're like, Dr. B, I really didn't like that grade I got on chapter 2 homework or chapter 1 quiz, go ahead and take it again. Absolutely. The idea here is that in accounting, and I believe, hopefully I said this the first class, in accounting, we learn by doing. The more that you practice accounting, the better you get at it, the more you understand the concepts. It's difficult just to read a book and take a quiz. You're not learning by doing that. You're not learning, read the book, take the quiz. That's not learning. Learning is, I read the book, I practiced the practice questions in the book, then I took the quiz. You learn more by doing that because we learn by doing in accounting. So please, if you don't understand a concept, of course, number one thing, reach out to me. Call me, email me, text me. Dr. B, I need your help. Okay, great. I'll help you out. And number 2, practice. The more you practice the stuff, the more you'll retain the information and the more you'll understand it. So I know, you probably hear that all the time, especially from me, but it's true. It's very, very true, especially in accounting, any type of math course, you learn by doing. And the same is very true in accounting. So that's kind of a recap on week 1. Now that we're in week 2, as I said when we first started, today we're going to cover chapters 3 and 4. For this week, by Sunday night, you'll have a Chapter 3 quiz and a Chapter 4 discussion forum. Okay, here's how the discussion works. For discussions, I'm looking for one solid original post by, we'll say Thursday night. Okay, by this coming Thursday, 2 days from now. 2 days from now, I'm expecting to see an awesome post from you for Chapter 4 discussion. Okay. Now, what do I mean by awesome post? A full paragraph, a full 2 paragraphs. Paragraphs, right? Paragraphs. Paragraph is like 6 or more sentences. That's a paragraph. I'm expecting 1 or 2 full paragraphs. That's 6 or more sentences per paragraph. And you need to include citations and references if you can, okay? I prefer that you do that. It's really important that you learn to do that process. It's what we call giving credit where it's due. Where did you learn the information? Where did you learn that information? And that's why you provide citations and references. Okay, and if you need help on that stuff, just let me know. I'll be happy to help you. So for the discussion, I'm expecting one or 2, preferably 2, full paragraphs, 6 sentences or more per paragraph. So that's 12 sentences total. Answering the discussion question with citations and references. Then, by Sunday night, you need to respond to 2 or more of your classmates. Okay? That's what a discussion is, right? That's why we call it a discussion. A discussion is not, I responded to your question and then we didn't talk about it. That's not a discussion. Discussion is a 2-way conversation within a group of people. That's a discussion. So, as a reminder, 1 or 2 full paragraphs, original post, due Thursday night. By Sunday night, you respond to 2 or more of your classmates. And your responses also need to be substantial. They cannot be, oh, I agree. That's not, what kind of response is that? No, I agree. It needs to be a full paragraph response to your classmates. Okay, that's a discussion. Any questions on that? I know I'm sorry I got on my soapbox, but I want to make sure that you all understand what I'm expecting of you for discussions. And that's how you'll earn the full 5 points per discussion. Questions? We're good? Really? Okay.
That's the ground rules going forward for all the discussion boards?
Yeah, grammar, punctuation. There's a great tool I recommend that all of you get. It's called Grammarly. Grammerly. Grammarly. Grammarly.com. It's a really awesome source. I'll put it in the chat. Grammarly.com. It is a really good tool. You can use it on pretty much all of your devices. What it does is it checks your grammar for you and your spelling. Amazing, right? And then you just click on the word that's misspelled or needs corrected grammar, and it'll either do it for you or give you suggestions. It will help you to become a better academic writer. So, and you can use it for all of your courses. It's free, by the way. It's a free tool. Wait, even better. Use your UDC email and password when you sign up for Grammarly. Okay? Why is that? Because the university paid for the subscription for the premium version of Grammarly. So use it, right? Sign up for Grammarly.com, use your UDC email and password to sign up for it, okay? And it should automatically link to your account. The university already paid for it. It's free, okay? So please use it. It can only help your writing. It improves your grammar, improves your punctuation, spelling, all that great stuff. Highly, highly recommend it. In fact, that's what I used personally. I use it all the time. I have it linked to my email. So when I write an email to you, you're like, oh, Dr. B is amazing with his spelling and grammar. Well, that's because I use Grammarly. right? And it tells me exactly the changes I need to make. I do it for email. I did it for my dissertation. I do it for all of my writing. Okay, it's a wonderful tool. I don't work for them. I don't get anything from them. I'm not endorsing them. But what I am saying is it's a great free tool for you to use. And I'll get off my soapbox. I apologize. Any questions on Grammarly? Please use it. It's good. I promise. Okay. Let's jump into chapter 3, chapter 4, shall we? As always, if you have any questions about the content as we're going through it, interrupt me. Ask your question. Because there's a good chance that one of your classmates probably has the same question. Okay, so let's jump into chapter 3. And I'm going to put it in full view mode, slideshow from the beginning. Chapter 3, the adjusting process. In chapter 1 and 2, we learned about the accounting cycle. Okay, the accounting cycle. There's 7 steps. Sometimes there's 9, mostly 7 steps in the accounting cycle. You start with your journal entries, and then you go through the process of allocation. Then we make adjusting entries. Adjusting entries are entries that we make at the end of the accounting cycle to close out our temporary accounts. Remember, temporary accounts, those are your revenue and expenses. I believe I said, probably in chapter 2, maybe chapter 1, that the revenue and expenses at the beginning of every year start at 0, right? Reason for that is because we close them out to the equity on the balance sheet. And so every year we start at 0 on the income statement, and then it adds up. And through the adjusting process, we make adjustments for closing out those accounts. We also make adjusting entries for depreciation and for a couple of other items. And we'll talk a lot about that throughout this chapter. But that's what the adjusting process is in a nutshell. Okay, in accounting, there are 2 types of accounting systems. There is accrual-based accounting and cash-based accounting. Accrual-based accounting and cash-based accounting, those are the 2 types of accounting systems. In this course, and also in 202, we will focus on accrual-based accounting. Accrual-based accounting means we record revenue and expenses during the time that it's earned. For revenue, we earn the revenue when we have delivered the product or performed the service. We've delivered the product or performed the service. Example, let's say you own a landscaping company and I pay you to come do the landscaping twice a month, okay? And I pay you up front. I pay you at the beginning of each month. You haven't yet come to do the landscaping. That is unearned revenue. It becomes earned revenue when you take care of the landscaping those 2 times during that month. Does it make sense?
Yes.
Great. It becomes earned after the service has been performed. The same is said when we talk about a product that sells goods or services. Let's say you have an Etsy store, okay? And you make jewelry or you are selling stuff on Etsy, okay? And that revenue, when you sell that piece of jewelry, it becomes earned when you ship it. when you put it in the mail. Okay, it becomes earned when you ship it. That is to say that cash may or may not have yet been received by the customer or from the customer. Okay, so going back to my earlier example, let's say you have a landscaping business. You come to my house and you take care of the landscaping twice a month. Okay, I haven't paid you yet for those two services, but the revenue was still earned. You earn the revenue after you perform the service. You still earn the revenue, but yet I haven't paid you yet. I'll pay you next month because you gave me a bill that says net 30. It means that I could pay you 30 days later. Okay? So I want you to disconnect the idea that cash and revenue, they're two different things. Cash and revenue are two different things. Revenue, that is the income that you recognize at the time the service is performed or when the good has been delivered. Cash is totally different. Cash don't matter. Okay? It doesn't matter when I got paid. It doesn't matter if they paid me before the service or after the service. Okay? It doesn't matter. Cash is just cash. Cash gets recorded on the statement of cash flows. Totally different than the income statement. We're talking about the income statement, okay? In accrual-based accounting, we record the expenses when they are incurred. I gave an example of a utility bill, okay? I received my gas bill a few days ago. The gas bill was for the month of December. In my accounting, I'm going to record that expense in the month of December because it happened in the month of December. And I might need to do that through an adjusting entry, which we're going to talk about here shortly. I record the expense when it happened, not when I paid them. Okay? I received the gas bill a few days ago. It was for the month of December. I record the gas bill for the month of December, not when I pay them. Not when I pay them. I'm going to pay them next month, right? Exactly. That's accrual-based accounting. The opposite is true with cash-based, and we're going to talk about that here in a second. Accrual-based accounting follows the generally accepted accounting principles which are required for all companies when they report their income statement, balance sheet, statement of cash flows. Now let's talk about the cash-based accounting system. With cash-based accounting system, I record the revenue and expenses when I receive the cash or pay the cash. That's why we call it a cash-based accounting system. It's cash-based. There's a lot of small businesses use cash-based accounting because it's really easy. There's no accounts receivables or payables. Well, there might be a payables, but there won't be receivables because it's cash-based. You're not going to send them a bill. They're going to pay you right then and there. An example of a company that uses a cash-based accounting system would be a barbershop or a salon. Okay? They use cash-based accounting. Why? Because the customer pays them right there. The customer pays you after you cut their hair. Okay? Customer will pay you after you cut their hair. So most barbershops and salons use cash-based accounting because they primarily deal in cash. So you cut my hair, here's the cash. When the salon or the barbershop receives their bills every month for the rent, the utilities, the whatever else they do, they record those bills when they receive the bills and when they pay them. Not when it actually happened. That's the difference between accrual-based accounting and cash-based accounting. In accrual-based accounting, I record the expenses and the revenue when I earned it and when the expense actually happened. When in cash-based accounting, I record the revenue when I receive the cash, and I record the expense when I pay the bill. Go ahead, David.
And I was asking, can you give us an example of that one, that accrual based, like how you did for the cash based, the barbershop?
Yeah, yep. So cash-based is the barbershop example. I cut your hair, you gave me cash, I record that cash as revenue right then and there.
Right.
And the same as when when the barbershop pays their bills, they record the expenses right then and there as they're paying the bills.
Right.
For an accrual-based business, which is usually going to be like a retailer, a clothing shop, for example, or a business
or like a business who accepts like credit, for example.
No. You want to think as well. It depends what you mean by credit. If
Like
it's a
credit card and like it didn't clear yet, so it'd be like under, say,
no. So David, here's a good tip for you. Credit cards in accounting are treated the same way cash is.
Okay.
Credit cards in accounting are treated the same way cash is, except if it's a company credit card. That's different. Okay. But if a customer pays you with a credit card, it's the same as cash. Okay. But if it's the business using the credit card, that's different. That's an accounts payable.
Right.
So an example for an accrual-based business would be a retailer, would be a business that has accounts payable and accounts receivable. So an example, let's say I'm a wholesaler, okay? I sell bulk items. And David has a retail business. And David places an order with me for bulk items to sell in his business. So I will give David what he ordered from me, and I'll say, hey, David, why don't you pay me in 30 days? Okay, great. That's an accrual-based business because they recorded the revenue when they sent David the inventory, but David hasn't paid him yet. So that would be an accrual-based business, is when the business hasn't been paid yet for their services or for their products, or if the business records their expenses when they actually happened, not when they paid it. Does that example help, David?
Yeah.
Cool. Awesome. Very good. And the list could go on and on. There's tons of different examples out there. But for most smaller businesses, they use cash-based accounting because it's a lot easier.
So would it be safe best to say like, okay, more so cash-based be product, or not product, but say service.
Yeah.
And accrual would be more so product.
Exactly. You got it. Yep. So most retailers or product-based companies will use accrual-based accounting, and most service businesses like a lawn care service or a barber shop or somebody who's performing a service, they'll use cash-based.
Right.
Typically. Right. Yep. Great question. Yeah. Cool. Another example might be a caterer. A caterer might use cash-based accounting because they will make the stuff for their customer, then deliver it. The customer usually pays them when they deliver it, so they might use cash. So, because catering can sometimes, in most cases, is classified as a service business rather than a retailer. Good questions. Okay, so now that you have a better understanding of accrual-based accounting and cash-based accounting, we need to talk about some more principles of accounting. One of those is called the revenue recognition principle. That's when we record the revenue when it's earned, and so, or when the service has been performed, or when the products have been delivered. That's when we recognize revenue. So all you need to remember for revenue recognition is we recognize revenue when we earn it. That's when we either perform the service or have delivered the product to the customer. And of course, revenue is normally measured as an asset, such as cash or accounts receivable. That's revenue. Revenue, nice and easy. Expenses. Next principle, expense recognition. We recognize the expense when it has been incurred, meaning I got my gas bill a few days ago. It was for the month of December. I incurred the gas consumption in the month of December. Therefore, according to the matching principle, that expense belongs in December. So by that process, we match our revenue and expenses in the period or month. A period, remember, a period is a month, a quarter, semi-annual, annual. We match our revenue and expenses in the period in which they happened, right? And adjusting entries, which is what this chapter is about, are required to properly match revenue and expenses. So, for example, I got my gas bill a few days ago. It was for the month of December is when the gas was used. I will make an adjusting journal entry to match that expense with the month of December, although I received it in January. And how do I do that? I put the month of December on the expense, and I do utilities expense for the month of December, accounts payable. With that journal entry, it puts the expense in the month of December, and it also generated an accounts payable that I need to eventually pay.
Is every expense going to have a month, or is every expense going to have a revenue month that it matches with?
Yeah, absolutely. So what that means is, great question, Alexis. So what that means is, just like my utility bill, right? I got my utility bill. It's a few days ago. It was for the previous month. It was for December, and so I am matching that utility bill with December because it says I used gas from December 1 to December 31.
Even something like office supplies?
Yeah, same with office supplies. So let's say you went to Staples or to Office Depot. I don't know if those places still exist. So let's say you went to Walmart and you bought some office supplies with paper, pens, pencils, or whatever you're using. You would record that expense when you purchased it for the business, okay? Because there's a good chance that you probably are going to use it for that month. And the thing with office supplies is office supplies is not going to show up every month, because oftentimes what businesses do is they'll buy in bulk. And so like I'll go to Costco and get like a case of paper. That case of paper is going to last me 6 months. Okay. So I'll record that expense of office supplies when I purchased it, and it'll be for that month. Although obviously I'm going to consume it in future months. Does that make sense?
Yes.
Cool. Awesome. So yeah, that's the idea, is we record the expenses when they're incurred. Okay, so let's talk about the adjusting process. At the end of an accounting period, usually at the end of a month, okay? We do this every month. We usually do adjusting processes every month. End of an accounting period, an unadjusted trial balance is prepared to verify that the total debit and credit balances equal. Remember the accounting equation. Assets equals liabilities plus equity. Assets equals liabilities plus equity. That accounting equation is always in balance. It's always in balance. And when we make transactions, okay, journal entries, when we make journal entries, which are business transactions, there's always going to be a debit account and a credit account for every single journal entry. And we need to make sure that those debits and credits are always equal. Okay, so how do we do that? We prepare what we call an unadjusted trial balance. And we'll talk a little bit about that here in the future. These account balances are reported in the financial statements without any changes. Okay. Some accounts on the unadjusted trial balance require adjustments. Okay. For example, let's say we inventory. Okay, inventory. Or office supplies. Let's take office supplies as an example. The daily use of office supplies would require many entries with small amounts. So we don't do it daily. Okay? It's like, oh, I used a ream of paper. Oh, that was $3, you know. It's like, I'm not going to do that every day. Are you kidding me? That's crazy. So we do it all at the same time at the end of the month. We track our use by making a general journal entry at the end of every single month to record the adjustments. Example would be rent received in advance. So we would, if we received cash from a customer before the service was performed, we record that revenue as unearned revenue. Unearned revenue. Let's say you have a lawn care company, okay, and a customer pays you up front for the month, and you're going to show up twice a month. They paid you up front for a month or 6 months or whatever, right? We record that revenue as unearned revenue. Unearned revenue. Unearned revenue is a liability account on the balance sheet. Unearned revenue. It's unearned because we haven't yet mowed the lawn. We haven't yet performed that service. It becomes earned revenue after we go and take care of the lawn. We perform the service, right? So what we need to do when that happens is we need to record an adjusting entry at the end of that month for those two lawn services. So at the end of the month, we would then debit unearned revenue and credit revenue. By doing that, by making that adjusting entry, we're taking it out of unearned revenue and putting it into earned revenue. Some revenue and expenses may be unrecorded at the end of the accounting period.
Excuse me, Dr. B.
Yeah, go ahead.
So if you receive the cash in May, but you don't complete the service until June, you wouldn't record it until June, right?
So Phil, great question. Here's what we would do, Phil, is we would we would record that receipt of the cash as unearned revenue in the month of May. Okay? It'd be unearned revenue in the month of May. And so we would debit cash by that amount, and we would credit unearned revenue. We would debit cash, which means we're increasing our cash, and we would credit unearned revenue, which means we're increasing our unearned revenue account, which is a liability. Then what happens, Phil, is when we get to the month of June and we perform that service or deliver that product, whatever it is, then at the end of June, we would make an adjusting entry. The adjusting entry would be a debit to unearned revenue and a credit to revenue. A debit to unearned revenue and a credit to revenue. What that does, Phil, is it reduces the unearned revenue account and it increases your revenue account. Does it make sense?
Yeah, so you just you do the adjusting entry whenever you complete the service, even if it's 2 or 3 months.
That's correct.
Okay.
Exactly right. Great
right,
job,
thanks.
Phil. Thank you for that question. That was an awesome question and a good example.
Thank you.
Thank you. Very cool. Okay, so where were we? Did we talk about that one? Oh, okay. Some revenue and expenses may be unrecorded at the end of the accounting period. For example, company may have provided services customers that have not yet been billed or recorded at the end of the accounting period. Okay, so here's once in a while, the business will get a little bit behind. I will delay sending out bills for whatever reason. Okay. So what happens is that I need to make an adjusting entry for those bills that I sent out to my customers at the end of the accounting period. That happens once in a while. And how do we do that? It's through the adjusting process. Let's talk about the process for making these adjusting entries, okay?
Excuse me, Dr.
Yes, please, Michael.
That sounds like kind of complicated, like if it was for tax purposes or something. How would you go about receiving the adjustable account or recording the adjustable account and then recording the revenue?
Awesome question. Thank you for asking that one. Okay, so here's how. Let's focus on the tax part first. Okay, so for taxes, as we know, every sale that we make, we have to also receive tax revenue from that customer. Although we don't call it tax revenue for us, it's tax revenue for the government, right? So here's how that works. We record the sale as revenue, and we also record the sales tax expense. Sales tax expense. So we record the sale of the product, whatever it was that we sold. And how do we do that? We debit our cash, assuming that we receive cash, and we credit our inventory account to reduce the inventory. And that, or we credit the sales account, right? So there's actually two entries that need to happen. We debit cash, we credit our sales account. That shows the sale of that inventory. Then what else needs to happen is we are going to, what are we going to do? We are going to credit our inventory account and debit our cost of goods sold account. That shows the sale of that inventory, and that's at cost, right? I don't know if we quite got to that point yet, but that's what happens when we sell a product. When we sell a product, there's two transactions. We debit cash, credit sales. That recognizes the sale of the revenue that you earned.
Okay.
The second transaction is we debit cost of goods sold, and we credit inventory. That reduces your inventory because we sold that product, and it increases your cost of goods sold. Okay, so that's the second transaction that happens. Then there's a third transaction that it gets used as in the adjusting process. That's for taxes. There was sales tax that we received from our customer on the sale of that product. So how do we do that? We debit sales tax expense and we credit sales tax payable. Okay?
Okay.
Debit sales tax expense, credit sales tax payable. What that's doing is we're saying, yes, there was sales tax involved here. I debited my sales tax expense to increase my sales tax expense, and I credited my sales tax payable to increase my sales tax payable. Now, at the end of that month, I need to then pay district government my sales tax, right? That I received, and I do that maybe once a month or once a quarter, right? I need to pay my sales tax. So what do? I create an adjusting entry. The adjusting entry is I debit sales tax payable to reduce sales tax payable, and I credit cash to reduce my cash. And,
Okay.
and that's the adjusting entry that we would make when we pay our sales tax the following month. Does it make sense?
I'm definitely gonna revisit, study up on it. But yeah, it did. Thank you.
Yeah, my pleasure. Yeah, and that's how the transactions work. So if you're using QuickBooks or you're using some type of other accounting software, which I hope you are, okay, because it makes life way easier, then those are the entries that you would make, and a lot of it's date driven. What does that mean? The date of that is on the transaction is how we know which accounting period it falls in. And we'll talk more about that as we go forward. So the adjusting journal entries brings the accounts up to date at the end of the accounting period through adjusting entries, which is what we just talked about. All adjusting entries affect at least one income statement account and one balance sheet account. The example we just used is on sales tax. Sales tax expense, that's on the income statement. Remember, on the income statement, we have our revenue and our expenses. That's on the income statement. On the balance sheet, we have assets, liabilities, and equity. The sales tax payable account lives on the balance sheet as a liability. So sales tax expense increases. That's on the income statement. On the balance sheet, sales tax payable increases. That's on the balance sheet. So that adjusting entry affects one income statement account and one balance sheet account. An adjusting entry will always involve a revenue or an expense account and an asset or liability account, which is what we just talked about. Now, of course, there are some general classifications of accounts that require adjustments. We call these accruals and deferrals. Accruals and deferrals. Okay, here's how it works. An accrual account is going to be accounts receivable and accounts payable. Okay. A deferral account is going to be unearned revenue or anything else that's unearned, right? That's a deferral. Think of the word deferral. The word deferral means to defer, to delay, okay? That's what the word deferral means. Accrual means it's happened already, and I am accruing that revenue, or I'm accruing that expense. So let's break it down a little bit further. An accrual occurs when the revenue has been earned or the expense has been incurred, but has not yet been recorded or paid. These would be, again, your accounts receivable and accounts payable accounts, okay? Accounts receivable, remember, what that means is we sold the product or the service to the customer. The customer has not yet paid us. We sold it, but have not yet been paid. That generates an accounts receivable. We call that an accrual. Accounts receivable is an accrual account for revenue. For expenses, it generates an accounts payable or wages payable. Remember, accounts payable is when I received the bill, but I have not yet paid the bill. An example of that would be utilities. I received my gas bill 2 days ago. It was for the month of December. I haven't paid that gas bill yet. So therefore, it creates an accounts payable. I will pay it eventually when it's due. A wages payable. When you see anything payable, we know it's a type of account payable. A wages payable is a little bit different. Wages payable means I have employees that I have not yet paid. I haven't paid my employees yet. It creates what we call a wage payable. Wage payable. Salary payable. Salary or wages payable. Okay? So if you have an employee that works for you and you pay that employee every other week, which is how most of us are paid, we create a wage payable. That wage payable is for the previous 2 weeks that employee worked. I reduce that wage payable when I pay the employee. So how does it work? The employee works their hours, okay, for that respective 2 weeks. I debit wage expense to increase my wage expenses, and I credit wages payable to increase my wages payable. Then 2 weeks later, when I go to pay that employee, I debit wages payable and credit cash to represent the payment of cash to the employee. Does it make sense?
Yes, sir.
Wonderful. Thank you so much. Yep, and it works really, wages payable works the same way that accounts payable does. I received my bill. I debit my expense for that bill. And I credit accounts payable for that bill. Then when I go to pay that bill later on, I debit accounts payable and credit cash. I want you to think about accounts receivable and accounts payable accounts as what we call contra accounts. Contra, C-O-N-T-R-A, contra accounts. A contra account means it goes up and it goes down. It goes up and it goes down. It's a temporary account. It's a temporary holding place. Okay, that's why we call it a contra account. It goes up and it goes down. It goes up, accounts receivable goes up when I'm waiting for a customer to pay me. It goes down when the customer actually pays me. Accounts payable goes up when I receive the bill. It goes down when I pay the bill. Contra account. Contra flow account, if you will. Okay, here's some examples. Nice visual representation, I think. Accrued revenue. Remember, accrued revenue, customer hasn't paid me yet. Okay? And then they pay me at the end of the month or after the end of the month. So how do I record the revenue that we earned? The transaction revenue has been earned. There's no journal entry that needs to be made because we already made the sale transaction, right? The adjusting entry that we make when we do earn the revenue is we debit accounts receivable and credit revenue. For expenses, I received my gas bill in January. It was for the month of December. So when that happens, I need to make an adjusting entry. The adjusting entry I make is I debit the expense, okay, in this case, utilities expense, and I credit accounts payable. That's accruals. Any questions on accruals? We're good. Okay. What about deferrals? A deferral is I earn it in the future, or I will recognize that expense in the future. That's a deferral. Deferral means it'll happen in the future. That's what deferring means. I'm deferring it till later on. Deferring it. A deferral is when cash related to a future revenue or expense is initially recorded as a liability or an asset. Here's how it works. The earlier example I gave was unearned revenue. For unearned revenue, cash received for future revenue. Let's say I'm a customer of yours, okay? And you take care of my lawn services. So how does it work? I pay you in advance, okay, for the month. And you come take care of the lawn twice a month. Okay? I pay you in advance. I pay you on the first of the month for that respective month. So for example, for the month of January, I paid you on January 1st for you to show up on the 15th and the 31st of the month to do the job, right? It's for you, when you record that revenue, it's unearned revenue. Because remember, it's revenue that you have not yet earned. You earn revenue when you perform the service. So at the end of the month, after you perform the service, you turn it into earned revenue. Okay? So here's how it works. You receive the cash from me on January 1st. You debit cash and you credit unearned revenue. You debit cash and you credit unearned revenue. That's when I paid you, but you haven't yet performed the service. Then after the month goes by and you showed up on the 15th and 31st and you took care of the lawn or whatever. So then after the month goes by, then you make the adjusting entry to earn the revenue.
So it's like, Professor, when, okay, like you said, they pay you, you get the cash, you label it in the cash, you label it as unearned revenue because you have the cash, you debit the cash, you notify that you have made cash. Then you notify what kind of cash was it. It was unearned cash. Then when you do at the end, you fix it, the adjustment, and you let it know, okay, now it's earned. And you, okay.
Yeah, exactly right. That's the good way to think about it. I mean, obviously, you're still depositing the cash when you get it into the bank account. You know, that part's obvious. So you got the cash.
Now you know what kind of cash.
Yeah, exactly. So how do you know what kind of cash it is? Well, you debit cash because it's cash. It's just cash, right? So debit cash, and then you credit unearned revenue because technically you didn't earn the revenue yet. You earned the cash, but you haven't earned the revenue yet. So debit cash, credit unearned revenue. Then, after the month goes by, you took care of the services. Then what do? We debit unearned revenue and we credit revenue. You don't do cash a second time because you only got paid the cash once for the whole month, right? You see what I'm saying? So first transaction on when I gave you the cash on the first of the month, you debit cash, you credit unearned revenue. Second, then the adjusting entry that you make on February 1st for the month of January is you will debit unearned revenue and credit revenue. That's how we recognize the revenue, that we've earned it. Make sense? Okay. What about prepaid expenses? This is a little bit different. Prepaid expenses is cash that I paid for an expense in the future. In the future. The best example I could give you of prepaid expense is insurance. Insurance, okay? An insurance expense. Car insurance, good example. Most of you have car insurance or house insurance or renter's insurance. Insurance, we all have insurance. Medical insurance, whatever. We record prepaid expenses when we pay the cash. For example, I like to pay my car insurance annually. So once a year, actually it's coming up, it's on March 1st. On March 1st, I'm going to pay my car insurance company for the full 12 months for the car insurance, okay? We call that prepaid expense. Prepaid expense. Why is it a prepaid expense and why is it an asset? A prepaid expense means I'm prepaying for the year ahead or for the few months ahead, right? Prepaid. Then what happens is as the months go by, I make an adjusting entry to turn it from a prepaid expense to a regular expense. So here's how it works. On March 1st, I debit prepaid expense. I debit prepaid insurance. My prepaid insurance is my expense, okay? I debit prepaid insurance. For me, a prepaid expense, or for anyone, a prepaid expense is an asset. The reason why it's an asset and not a liability or just an expense is because that money that we paid, it's technically still ours. It's technically still ours until until we consume it. Until we consume it. For example, I can cancel my insurance policy and they would have to pay it all back to me. That's why it's an asset. That's why it's still an asset. It's still an asset to me. It becomes an expense when it's consumed. Go ahead. What's your question?
I was going to say, would you still credit, or would you credit cash?
Yeah,
when
absolutely.
You're paying, so you'd credit cash first, and then you debit the prepaid expense to start out with, and then you would go down the line from crediting prepaid expense to debiting expense at the end.
Yeah, correct. That's exactly right. So the first transaction is I debit prepaid expense, credit cash, because I paid them the cash on March 1st. Then at the end of March or the beginning of the following month, April, I will make an adjusting entry for the month of March for insurance. That adjusting entry will be debit prepaid expense, credit insurance expense. And I will do that at the end of every single month for that respective month as an adjusting entry. Does it make sense?
Yes.
Perfect. Cool. We're getting there. Yay. We're learning. Okay. Any questions on deferrals? Unearned revenue, prepaid expenses. Any questions on those two topics? Good so far? Okay. Here's how those entries look, just to kind of recap what we just talked about in my examples. So unearned revenue, cash has been received for the revenue that will be earned in the future. So how does that work? I perform a lawn service for, let's say I'm the landscaper, okay? And you're my customer. You paid me to come mow your lawn twice a month. You pay that up front. So on the first of the month, you paid me the cash. So I record that cash is a debit to cash and a credit to unearned revenue. Then at the end of the month, after I came to your house and I mowed your lawn twice, okay? So at the end of the month, I then make an adjusting entry. I debit unearned revenue and credit revenue because at the end of that month, I'm recognizing the fact that I performed the service. Okay, that's unearned revenue. Prepaid expenses. On March 1st, I will pay my car insurance for the whole year. Okay. So when I do that, I'm going to debit prepaid expense and credit cash to show that I'm paying cash out and I am prepaying an expense, in this case, car insurance. Prepaid expense, as you know, is an asset account. It's an asset because I can always cancel that policy and they'll have to pay me back, right? That's why it's an asset. Now, at the end of each month that I'm consuming that insurance every month, right? So at the end of March, I will debit insurance expense and credit prepaid expense to represent that I've consumed that expense for that month. Make sense? You'll do that every month until it reaches zero. Good? Okay. That's deferrals. Okay, the unadjusted trial balance. This is something that we talked about a half hour ago. The unadjusted trial balance. We perform this to make sure that our debits and credits balance, right? And we do that to make sure that there are no adjustments that still need to be made. We perform the unadjusted trial balance. And we can see all of our accounts listed out from our our balance sheet accounts to our income statement accounts. We got cash, accounts receivable, supplies, prepaid insurance, land, office equipment. We know that all of those are asset accounts, right? Those are all asset accounts. Cash, accounts receivable, supplies, prepaid insurance, land, office equipment are asset accounts. Then we have a couple of liabilities. We have accounts payable, unearned rent. Those are 2 liability accounts. And on our equity side, we have common stock, dividends, fees earned, and then our expenses. Those are our equity accounts, right? And we see at the very bottom that after we've listed out all of our accounts and based off of their balances for those accounts, we see that they're in balance. Our debits equal our credits. That's what we want to see. So you might ask, Dr. B, how do you know if it's a debit or a credit balance? How do you know if it's a debit or credit balance? We talked about this in chapters 1 and 2. You need to know the type of account that it is to know if it normally carries a debit or a credit balance. We know that assets normally carry a debit balance. We know that liabilities normally carry a credit balance. We know that equity normally carries a debit balance, and we know that sales normally carries a credit balance. And we know that expenses normally carry a debit balance. That's how we know whether it's a debit or a credit balance. And you would know this by looking at your balance sheet. Let's talk about the effect on the accounting equation. Okay, our company agreed to sign a contract on December 15th to provide services at a rate of $20 per hour. At the end of the first month, which was only 15 days because the contract was signed December 15th, at the end of the month on December 31st, we provided a total of 25 hours of service. So here's how we record the revenue for that month, which, by the way, is only half a month. At the end of the month, we debit accounts receivable and we credit fees earned. Remember, fees earned, that's the same as saying sales. But here's the difference. Fees earned, that's for a service business. Sales are for a retailer. But they're both revenue accounts, right? Just how they're named. So accounts receivable, debit, credit, fees earned. That's our revenue account. How do we know how much? Well, we work 25 hours at $20 per hour. 25 times 20 is 500. What is the effect in the accounting equation? Accounts receivable increased by 500. So we debit accounts receivable 500, as we can see on our T accounts. Accounts receivable beginning balance increased by 500. The adjusted balance, also known as an ending balance, $2,720. On the equity side, fees earned, we sold, our revenue account. Revenue account, fees earned, which is an equity account. Beginning balance increased by 500. Adjusted balance, that's accrued revenues. It's a nice example. Chart of accounts. We talked about the chart of accounts.
I have a question.
Yes, please.
The 12 and the 41 are reference numbers, aren't they?
That's correct. Yep. The 12
where do they come from in this example?
Yep, they actually come from the chart of accounts. Yep. So every company has what we call a chart of accounts, and here it is. Here's exactly where it comes from, right? Here's 12. Here's 12. 41. Yeah, 41 is here. Okay. This is what we call a chart of accounts. Every account in the chart of accounts has a reference number, just as Nitisha just said. We list them out from assets to liabilities to equity. We start with assets, and we list all of our accounts for assets. We got cash, accounts receivable, supplies, which is also known as inventory. Your book calls it inventory supplies. It's inventory. Cash, accounts receivable, supplies, also known as inventory. Prepaid insurance, land, office equipment, accumulated depreciation for that office equipment. These are all asset accounts. You'll see that the reference number starts with a 1. Since assets is number 1, all of the accounts within assets also start with a 1. We call these reference numbers. Cash is 1-1, accounts receivable 1-2, supplies 1-4. The reason why cash is 1-1 is because cash is the most liquid of the asset accounts. Accounts receivable, second most liquid of the asset accounts. Very good. And so forth and so on. So this is called this chart of accounts. Under liabilities, we have accounts payable, wages payable, unearned rent. 2-1, 2-2, 2-3. Why 2-1, 2-2, 2-3? 2-1, accounts payable. Again, most liquid. That's why it's the first one under liabilities. Wages payable will be next, then unearned rent, and then any other unearned accounts. And these are just examples. Not every company has the same exact chart of accounts, but they will have very similar names. Because the reason for that is because not all companies are the same. Some companies have fees earned, other companies have sales, right? Not all companies have stock, right? Stockholders' equity 313233. You see the pattern, right? On the income statement, same process: revenue and expenses. Revenue, fees earned 4.1, rent revenue 4.2. Different types of revenue for this particular company. Then expenses 5.1, 5.2, all the way to 5.9. Wages expense, supplies expense, rent expense, utilities expense, insurance expense, depreciation, miscellaneous, and so forth and so on. There's probably a lot more than that. This is just a nice example of a chart of accounts. The chart of accounts shows you the types of accounts that the company has, and it also shows you the reference number for each account. So when you're writing out your journal entries, what you have is the date. Then you have the account names for the debit and the credit. There's going to be a reference number for those accounts for each one.
Would there always be a reference number? Because I remember in previous examples it wasn't.
Yeah, not always. Sometimes they'll be there, sometimes they won't be there. It depends on the accounting software. And if you really need to know it, right? Some companies, they don't include the reference number. Some do. It just kind of makes it easier when you're tracking it back. That's why they exist. Good question. So that's the chart of accounts. Okay. Effects of omitting the adjusting entry from accrued revenues. We talked about accrued revenues. Remember that those are, we perform the service, deliver the good, haven't been paid yet. That's an accrued revenue. Adjustment for accrued revenue, 500 is recorded. The income statement and balance sheet prepared on December 31 will be misstated. Okay, here's what happens. If I accidentally record an unearned revenue as a revenue, or if I accidentally record revenue as being unearned, I'm either going to understate or overstate my revenue. Understate means, well, it's actually should be higher than that. Overstated means it should actually be lower than that. So sometimes mistakes happen, right? And so there will be a misstatement on your accounts. And so, for example, in this example, we accrued revenue of 500, but it hasn't been earned yet. So revenue would be understated by 500. Revenue would be understated by 500, which means the assets will be understated by 500 because we haven't received the cash yet. The net income will be understated by 500, which means our equity will be understated by 500 because we haven't recognized the revenue yet. So these are the types of effects that would happen on something like that. Here's another example. This is for accrued expenses. We have an employee that works for us. The employee worked a couple of hours in the second part of December. We paid the employee $950 on December 13 and then $1,200 on December 27. As of December 31, our company owes the employee $250 for Monday and Tuesday, December 30th and 31st, respectively. Because here's what happens. Every calendar month, there's a certain number of days. In December, it's 31 days. I might not yet pay the employee until the beginning of January, but I still owe them for December. Okay? If I paid the employee already on $1,200 on December 27, they probably worked a few days in the last part of the week, which was Monday and Tuesday. So I need to figure out how much do I owe the employee for Monday and Tuesday, which is December 30 and 31, the last 2 days of the month. Figured it out, it's $250. So I debit wage expense $250 and credit wage payable $250. This is the adjusting entry that I would make. What's the impact on the accounting equation? I increase my wage payable, which is a liability account, by $250, and I increase my wage expense because the employee worked those 2 days during the month of December by $250. We paid the employee $1,275 on January 10th. Of that amount, $250 came from December. That's the 2 days the employee worked, right? So how do I record that transaction? I debit wage expense $1,025. Why $1,025? Because $250 of that actually came from the previous period. I debit wages payable $250 to reduce my wage payable from the previous month. And I credit cash $1,275. You see that there are 2 debits and 1 credit, but they still balance, right? Remember, your debits need to equal your credits. You can have multiple debits. You can have multiple credits, but the 2 debits and credits must always be in balance. Questions? Are we okay so far?
Using QuickBooks, that'll stop you from making a simple mistake,
Yes.
right?
Yeah, absolutely it will. Great question, Michael. Yes. I prefer QuickBooks. I've been using it for many, many years. I started using QuickBooks for my business back in 2002, thereabouts. Yeah, I love it. It's super easy to use, very user-friendly. You just enter the data. It generates the financial statements for you based off of the entries that you make. And if you're good enough to track your taxes, your tax expenses, it'll even do that for you. So it's good software. Yeah.
But it is better than to use what is better, to use that, or should I hire an accountant and do that for
No,
me?
don't hire an accountant for that. That's crazy. Accountants are expensive, right? So for your business, I would just use QuickBooks to record your transactions, your revenues, and your expenses. And any accruals, you could do accruals in there as well. I would use QuickBooks, and then what you might want to do, Pavle, is you could hire an accountant to make sure that your books are correct. Have them look at it once a month or something like that.
Yeah. I mean, on the end of the year, for the tax. Okay.
Exactly. Okay. Yep. That's what most people do. That's what most small business owners do, is they'll track their revenue and expenses and their financial statements throughout the year, and then at the end of each year, for taxes, they'll make sure that the books are correct by sending them to an accountant. The accountant will review, and then sometimes the accountant is the one that makes adjusting entries. It depends, but yeah, that's a very good concept.
Thank you.
Absolutely. So this slide here kind of illustrates exactly what we just talked about in our example when we paid our employee. The last 2 days of December, since the month of December for that particular year ended on a Tuesday, we had to make sure that those 2 days were allocated to the month of December. And so we have them allocated here at $250. We pay, we pay our employees usually every 2 weeks. Usually, not all companies do it that way, but some do. We pay every 2 weeks, so the payment that we make for December will actually happen in January. Now, with that January, we have the first 2 weeks of January, except for those first 2 days that actually belong to December. So we record the expense for the rest of those first 2 weeks of January. We add that up plus what we need to pay the employee for December. to show what we're paying for that first pay period in the middle of January. Just nice visual representation of it. And of course, if there's a mistake involved, you can end up understating or overstating the accounts if you were to adjust that wage mistakenly in the following month. That's kind of what shows us. Unearned revenues, just like we talked about before. If there's an unearned revenue, when it becomes earned, the entry is debit unearned, in this case rent, and then credit rent revenue. The same process applies. If it's overstated or understated, it'll have an effect. Prepaid expenses. I gave the insurance example. It's a very accurate example. These are the types of entries that we make. You debit the expense and credit the prepaid expense. Actually, here's the insurance one. How about that? Debit insurance expense, credit prepaid insurance when we actually recognize the consumption of that insurance every month. Is it overstatement, understatement? Okay. Okay, so what we just talked about, we talked about, just to recap, we talked about accruals, deferrals, and the adjustment process. We also talked about making adjusting entries. All that's fantastic stuff. With adjusting entries, we also need to adjust for this thing we call depreciation. What is depreciation? Depreciation comes from the reduction of value in our fixed assets. Fixed assets. Remember, and I think we talked about fixed assets. Fixed assets is property, plant, and equipment. Those are fixed assets. Fixed assets are property, plant, and equipment. They're physical assets that the company owns. Property, plant, and equipment. They are permanent or they have a long life. Property, plant, and equipment. Those are fixed assets. Over time, the value of the fixed assets decrease. Think of it this way. Think of your car. Your car, okay? Your car loses value over time because you're using it a lot, right? Your car loses value over time. So let's say you bought a car a few years ago and at $25,000, now it's worth $5,000. Okay, that's a car, right? Your car depreciates in value. Your asset, your fixed asset, which is your car, depreciates in value.
Dr. V.
Yes.
So depreciation is why it's very important to hire an accountant at the end of the year, because there is this section 179 where if you own a business and the equipment or software is in use to your service, you can actually receive a credit for it because it depreciated. So you can receive a credit in the same year instead of depreciating it over 5-4 years.
Yeah, Richard, absolutely correct. Yeah, depreciation is probably one of the more trickier ones. And the reason being is depreciation, there are certain tax credits that you can earn through depreciating assets over time. And there's a couple of different methods that you can use to depreciate over time. These are in the schedules. The schedules of depreciation are updated by the IRS every single year. That's the 179 that you're referring to. Those can be found on the IRS's website. So for those of you who have companies and you have fixed assets like property, plant, and equipment, and you need to ensure that you are depreciating it correctly, the IRS will tell you what the useful life of those assets are and how much depreciation can be taken on them by looking at the tables. And we'll talk a lot more about that here in the next few slides and also in the future chapters. But Richard, absolutely, totally recommend an accountant to help you with depreciation. Thanks for bringing that up. Okay, so as time passes, assets lose their useful life, their usefulness. We do this through the process called depreciation. We depreciate fixed assets except for land. Land is the only thing that does not depreciate in value. Well, according to accounting rules, land does not depreciate in value. I could argue otherwise, but that's the way things work when it comes to land. The reason why land does not depreciate is because in accounting, land is said to be infinite. The planet, the physical land that your house sits on, that the roads sit on, and everything else, the planet is considered to be infinite, meaning lasts forever. Although we know that's probably not true. But that's what your accounting friends say. Okay, so land is considered to be infinite, which is why land is the only one of the fixed assets that does not get depreciated. Okay, so land does not get depreciated, but your property and your building and equipment will depreciate over time. Okay. So how do we make the adjusting entry for it? At the end of each year, we debit depreciation expense and we credit accumulated depreciation. That's not the only entry, though. We, over time is not the only entry. We debit depreciation expense and we credit accumulated depreciation. What this does is we recognize the expense of depreciation, that's an income statement account, and we have accumulated depreciation, which is an asset account. Accumulated depreciation will always be negative because, or with a credit balance, I should say. Accumulated depreciation always has a credit balance because it takes the value from the fixed asset and moves that value to accumulated depreciation over time by making the adjusting entry debit depreciation expense, credit accumulated depreciation. Do that every year. Now, the reason why we debit depreciation expense and credit accumulated depreciation is because we cannot adjust the original cost of a fixed asset. That needs to remain the same on the balance sheet. The reason why is because we cannot devalue a fixed asset by simply adjusting its original cost. You can't do that. So we have to recognize that the value is being reduced off of our fixed asset by debiting depreciation expense and crediting accumulated depreciation. Just as we talked about with accounts receivable, accounts payable, accumulated depreciation is also considered to be a contra flow account, but for an asset. This is because accumulated depreciation accounts are deducted from the related fixed asset on the balance sheet. It normally carries the opposite balance, which is why it's contra, right? as I said earlier, accumulated depreciation normally carries a credit balance, which is contra to the fixed asset, which carries a debit balance. This is how we show the deduction in value over time. To recap, land does not depreciate, buildings and equipment do. And so for each fixed asset account, you'll have a related accumulated depreciation for that fixed asset account, which is what we can see here, fixed asset account, contra asset account. And the reason why they're separated is so we can properly track the value of each of the fixed assets. Here's an example. For the month of December, our office equipment depreciated by $50. The adjusting entry I need to make is I debit depreciation expense, $50. I credit accumulated depreciation for the office equipment, $50. The impact on the accounting statement, assets, we credit accumulated depreciation, $50 to offset our asset account for office equipment. And we debit depreciation expense by $50 to recognize the increase in expense. Okay. Now, what happens to the difference between accumulated depreciation expense from the original cost? The difference between the original cost of the asset to the accumulated depreciation is called book value. You've probably heard this before. So let's say you ever wanted to look up the value of your car in its current condition. You would look at the Kelley Blue Book value or the NADS Blue Book value. The Blue Book value tells us the value of the asset in its current condition. To figure out the book value, you simply take the original cost of the asset and you subtract the accumulated depreciation for that asset. And of course, the market value will always be a little bit different than the book value because of the depreciation allocation method, not a valuation method. We'll talk more. We're not going to talk too much about that. It's a little bit more complex. Any questions on depreciation? Does it make sense? You all can still hear me, right? I know that Nitisha's having some audio problems.
Yes.
Okay, great. Thank you. Nitisha, if you can still hear me, you might want to just try to disconnect and reconnect. I'm sorry, I don't have a good solution for you on that problem. Okay, so we're all good on depreciation. I'm not going to go over that one. The adjusting entries, just as we talked about before, we already talked about accrued revenues and expenses. Let's just focus on the depreciation one, since that's one we just talked about. This slide's a nice recap of everything that we talked about for the adjusting entry process. Accrued revenues, we talked about that. We talked about accrued expenses, unearned revenues, prepaid expenses. Let's talk about depreciation. For depreciation, we debit depreciation expense, credit accumulated depreciation at the end of each year. And what that does is it contraflows the asset. The entries, as I said before, you're adjusting entries when you're making the unadjusted trial balance. You want to make sure that your debits and credits balance. And to figure that out, we list out all of the adjusting entries that we've made throughout that year. And at the end, you'll see that the two balance, debit and credit balances.
I have one question, Professor.
Yeah, Pavle.
So you said previously that we are allowed to have like multiple accounts, like for credit and debits. Am I right?
Yeah. So if you're making an adjusting entry or even like a prepayment, yeah, you could have like 2 or 3 debits and 1 credit, or something, or a combination like that in one of the entries, as long as your debits and credits balance.
Okay, but are we? My question is, on the end of the year, do we need to put everything in one, or we are allowed to have like that separate?
It should be separated, ideally. I mean, you could have it all in one, but I wouldn't. That makes it really complicated. It's better to have them separated out. Yeah.
Okay, thank you.
You're welcome. Because the problem is, like, if you have them all in one transaction, it gets really, really muddy, and it gets difficult to track things. That's the reason why. It's a good question. Okay. I'm going to go through all that stuff. Okay, the adjusted trial balance. After the adjusting entries are posted, an adjusted trial balance is prepared. The adjusted trial balance verifies that the debits and credits of the trial balance equal. And the adjusted trial balance looks like this. We list out all of our accounts, our debits and our credits, and do they balance? In this case, they do. If they don't, then there's something wrong. There's a problem there. For decision makers, when you're looking at your financial statements, balance sheet, asset, we like to analyze the information. And we can compare our financial statements and their total amounts to the same statement through what we call a vertical analysis. A vertical analysis shows us the difference in revenues and expenses from a dollar amount and also from a percentage. The percentage is a percent change. Percent change. How do you get a percent change? A percent change is recognized as new minus old divided by old. New minus old divided by old. The new dollar amount minus the previous dollar amount divided by the previous dollar amount. That's how you get percent change. That's horizontal analysis. In vertical analysis, the percentage is expressed as either a percentage of total revenue on the income statement or a percentage of total assets on the balance sheet. If you're ever curious, you're like, I wonder how much what percentage my total rent is for the year out of all my expenses. What's the percentage of total rent? You can figure that out by doing this vertical analysis. We take 100% is the revenue, and to figure out the percentages, you just simply take the dollar amount for that expense and divide it by the total revenue. So, for example, wage expense is 32%. How did we get 32%? We took the wage expense amount, $60,000, divided by the total revenue, $187,500. $60,000 divided by $187,500 is 32%. Well, it'll be 0.32. You just multiply by 100 to get the percentage. And you can do that for all of your expenses. This is a nice representation that shows us what percentage is each expense. And, when I'm making decisions in business, I like to know what percentages are those expenses. That is the end of Chapter 3. Are there any comments, questions, concerns that you have for Chapter 3 before we get into Chapter 4? Anything at all on the adjusting process? We're good? Okay, great. I'm going to stop this recording for chapter 3, and we'll start a new recording for chapter 4.